Let's now bring in Fundstrat's head of research and Fundstrat Capital CIO, Tom Lee, along with Wells Fargo's head of equity strategy, Chris Harvey. Tom's a CNBC contributor. You also make the argument that all this concern over inflation related to tariffs is too aggressive and overdone.
That's right. So what you hear is, here's what should be happening. Prices should be going higher. You hear that from economists. You hear that from the Fed. You hear that there's a lag. What we look at is what's actually happening. And what companies are saying is, we see tariffs. We're going to mitigate them to the best of our ability, and they are. Right? If you look at Costco, what is Costco saying? We're not going to raise prices on a lot of that day-to-day stuff. We'll raise it on discretionary. We'll keep the basket under control, and we're really not going to push along inflation. And that's what's happening. So this whole belief that we're going to see this inflation shock, I don't think it's really well-founded. If you're looking at the data, if you look at what companies are doing right here, right now, and what you expect them to do, inflation's not going to be a problem.
I think, Tom, you agree with that, don't you?
I do. You know, one of the things that I think helps is if you go to the May CPI report, core inflation was 0.13% month over month. The goods component was in deflation, which is affected by tariffs. And then if you look at core, the two biggest contributors were housing and auto insurance. That was 0.14. So outside of housing and auto insurance, we had deflation in the May CPI report. I don't think tariffs are going to cause housing prices to go up, nor is it going to cause auto insurance. So to me, the Fed is, I think, shifting to looking at expected tariffs, but not realizing the real driver of inflation. 75% of inflation since 2019 was housing and auto insurance. Those are both actually starting to cool.
So are we all, not we, you, three, all suggesting that the Fed, I think the professor already said as much, that the Fed should cut rates in July? Harvey, you first. This sounds like yes.
So what the Fed has said, which I agree with, the Fed's saying, hey, the economy's still strong. We still have time to take a wait-and-see approach. It's in our best interest to do that. And I don't think they're going to move in July. I don't think they should move in July, but I do think later this year.
You don't think they should move in July?
No, I think they can take their time. I think they can take another meeting or so, let the data come in, convince themselves of what they need to convince them of, and then we'll normalize later in the year. And then we can all just move forward.
So, Tom, do you agree with that? I mean, you agree that Waller might be jumping the gun here with calls for July?
You know, I think if we looked at the Fed's framework that they've repeated in statements over the last 8 meetings about data dependence, then they should have cut, or they should be cutting in July. So I think this last meeting seemed to have changed the guideposts from data dependence to forward-looking expectations around tariff inflation that I think is why markets are starting to question the Fed's rationale. And Professor Siegel points it out, long-term inflation expectations are lower today for 1 year forward than they were in December. So we've gone through a full tariff liberation day and expected inflation's lower. Yields are actually lower. I think the market is moving ahead of the Fed and saying the Fed should be cutting sooner.
So at what point is the market going to get, Tom, too upset by the pace that appears to be slower than it would like?
Well, there could be an accident, right? Because I think what we are ignoring is housing is choking and collapsing under the weight of higher interest rates. And the labor market isn't as strong as it appears. I mean, when we look at the ability to get a job, it's much harder. So as Professor Siegel says, there's long and variable lags. There could be an accident where the Fed will have to panic. So I think that's something we have to watch in the incoming data.
When you say accident, what do you mean? On the long end of the curve, like rates go up too much? What do you mean?
No, I think that there could be a point where the Fed suddenly realizes the risks are actually to the downside for the economy weakening. And so the Fed will actually have to respond to an economy that they're strangulating and really fighting what they believe is a supply shock inflation. So I'm a little concerned that the Fed could be late if they continue to hold.
Adds to the uncertainty, the Fed's roadmap and the Middle East, you throw that into the mix too. We're not really sure what's going to happen there. What's your best idea now in light of all that?
Best idea is still AI. AI has run, but it's still, if you're looking 12, 24, 36 months out, it's still that AI trade. This is not like the late 90s. The player's not like the late 90s. The opportunity's not like the late 90s. This has legs. The AI diffusion, the Mitigation of AI Diffusion Act has given it legs. and we will continue to see AI. That is the U.S. secular robust trade. That is the trade that you need to be in if you're not in already.
Tom, you guys sound like you're sharing research.
Yeah. I mean, I broadly agree. I might add that I think interest-sensitive groups are going to benefit because they're going to start to look forward and realize the Fed, if they are a little slower this year, they're going to be more dovish next year. That's good for financials. You know, it is good for the industrials, really good for Bitcoin and small caps as well.
Professor, when you look at the tech trade, do you feel like the stocks are overvalued, or do you believe Harvey, which says, no, they're giving you every reason and they keep telling you and proving to you, including in the most recent earnings season, exactly why money should still go to those stocks?
Well, AI is very important, and certainly those companies, I think, will continue to prosper. But let's not forget about the AI users. And I think it's in the infancy of use to cut costs by regular firms that are not in technology. And I think in some ways tariffs might be one of the things that pushes them to more intensively use AI to cut costs. We saw during the pandemic, all of a sudden, people use Zooms. They saw, well, I don't have to have a business meeting, in Chicago or someplace around the world. We could use other technologies. That did cut costs at that time. And so the users could benefit in the future as much as the producers in the AI technology space. So, I'm very optimistic about firms implementing AI to cut costs, maintain margins, or even maybe expand them despite the tariffs.
Are we going to be okay, Chris, this next earnings season? We were better than expected in the last one.
Right.
And I don't know what's going to be in the next one, but what about this one that's coming up after the second quarter earnings?
I think so. Everything we're seeing from the consumer is still okay. You're seeing some weakness, but not a ton. CapEx still really strong. The shock from April really hasn't affected things all that much. I think if you have that weakness, but we get some progress on trade and tariff, people will look through it. But if you're asking the question, are numbers going to be solid? Numbers will be solid.
Yeah. Tom, you agree with that?
I do. I mean, I think companies have proven many times over the last 5 years that they are incredibly resilient and adaptive. This is really the fifth shock that they've absorbed. I do think one of the consequences of sort of surviving COVID and fastest hikes in history and now this tariff shock is that investors are going to start to assign higher multiples to the companies that are succeeding. So I do think PE expansion is a theme we should think about the next 12 months.
All right, we'll leave it there, everybody. Good weekend to all. Professor, thank you as usual. And Tom and Chris, we'll see you again soon.